Very good evening. So, warm welcome to all of you on the behalf of Ahmedabad Management Association. I am Dr. Paresh Karia. Basically, I am a chairman programs at AMA and also director in AIQ India. So, I have a privilege to introduce Parthiv today. Parthiv is basically graduate engineer from our Nadiad. We call it DDU, right? DDU. And after completing the engineering B, electronics and communication, he moved to USA, where he did MS, right? And MS. Just now I told you keep silent, so otherwise we are very strict. Okay. So he has done MS from USA. Right now, Parthiv is very active in stock markets, having I think more than 12 plus years in this field, experience and exposure. He's very passionate. I can make out because Parthiv, I have seen you in the TV also. I'll talk about, right? So he's having passion, and he's very much interested to know about company and its product. He does in-depth research to properly guide the investor. He has attended lot of listed and unlisted company. He visited his plants, he attended their management meetings, attended their conference calls, their annual general meetings. That shows his exposure to the field and the advisory on the stock market, right? He is visible regularly at CNBC, right? English, Hindi, CNBC Bazaar, and ET Now Swadesh for stock, right? And Swadesh especially is available for advisory. If you have any query on the stock, Parthiv gives you the direction, that do's and don'ts about that stock, right? So very much in depth on the stock market. He is a guest faculty at Nirma University, Ahmedabad. He loves to share his learning, so that is why he is here today, right? And before he starts his talk, Parthiv, welcome on behalf of all the audience and AMA with a flower. So just 1 minute last to all of you. The title of the talk, if you read, Vision 2030, right? Stock market, India, right? Very interesting topic. And I will tell you why this topic. We overestimate short term, right? But we underestimate long term. So this is a right fit. And another, the hypothesis for this talk, Vision 2030 Indian stock market is, this stock will definitely provide purpose and direction to the investor. And today, all of us, we are aware that simply fixed deposit or government bond will not help us to survive in the high inflation market. So we need Parthiv. So Parthiv, without taking much time, you are welcome here. Please.
Respected Shri Paresh sir, thank you so much for this kind and wonderful introduction. I'm really humbled. And also I would first call as friends and delegates from National Stock Exchange. Thank you very much for giving me this platform and giving me an opportunity to talk on such different topics. So before I start, the real tough thing to do was to find out a topic, because we are living in an era where there's a lot of information. There is WhatsApp University, there's Facebook University, there's Twitter University. So always becomes very, very challenging. And even more challenging when you have a speaker whose mindset is more about long term. Because the real definition of long term in Ahmedabad, what I've witnessed, we ourselves are brokers since the last 25 years, it starts at 9:30 a.m. and ends at 3:30 p.m. So becomes even more challenging. So just to give you some background, basically we are a stockbroking firm and I feel privileged. I'm the third generation here. My maternal grandfather, Mr. G.B. Desai, was the former BSc president, and it's all thanks to him that my family and I, we are in this field. And again, it's all thanks to him that, you know, we learned the art of what is value investing, what is research-based investing, what is, how important it is to meet the managements at the AGM, meet the managerial level people who can give us the right direction about the company, and also understand the body language. So that is where from probably I come from. And maybe it might be a little repetitive for some of you all, but this is something that I always like to talk about, is my failure. And running in the blood, back in US, I was a radio frequency engineer. So designing in-building distributed antenna systems in places like AMM. What used to happen is that over there again, knowing that it runs in the blood, Dow Jones had fallen from 14,000 to 12,000 levels. And obviously, like as a value investor, you're like 20% it's down. It's a great time to buy the best of the best stocks. So I had saved $20,000, a meager amount back then, but a big amount for me because as a student, saving $20,000 was quite big. And I deployed all of it because over there, the bank FD, which they call as CD, was yielding 0.5% per annum, right? So I deployed all my funds in stocks over there, and I bought stocks like General Electric at $32, Wells Fargo at $42. I also had Lehman Brothers at $10, thinking it's a value buy. And just a day prior, George Soros had bought. So I was like, if George Soros is buying, you know, I can also do that. Another mistake, because he must have allocated 0.005% of his net worth, and I allocated almost 5% of my $20,000 net worth. So again, a mistake which I really would love to share so that that's not repeated. And again, J&J, the best of the best companies. After 1 week, that portfolio was up by 10%. And I called up my dad, being a stockbroker out here. I'm like, Dad, you know what? You're always talking about Reliances of the world. My one General Electric is equal to like probably tens of 50s of Reliances of yours. So such a portfolio is not possible to be built in a country like India. So like, okay, I'm happy for you. Let's see how it goes. And then came the Lehman Brothers crash. I was down by 60%. Imagine doing radio frequency designing, having my portfolio open in the other end, daily hearing about news of layoffs and Lehman Brothers, Wachovia, so many companies, it started with Bears and Stearns, Wachovia, WAMU, Washington Mutual, so many companies daily collapsing. And the portfolio value was down by 60%. So I was down in terms of notional value by $12,000. So I was terribly depressed. I was like, Dad, I think we are in the worst business. We should not be in this business. So my dad is like, don't teach me what business I am into. You think what you have to do now. So I'm like, should I be removing that remaining $8,000 and parking in the fixed deposit? Because I was like 22 years back then, very mature. So he's like, what type of stocks you bought? So I told him the names. So he was like, okay, they are all quality companies. How much are you saving every month? So I said around $1,500. So he said, okay, do this. Entire $1,500 deploy in these stocks of your portfolio. Do a SIP, which is now what you call a systematic investment plan. So my GE, which I had originally bought at $42 or $32, was down to $8. So every month I was buying at $8, $9, $12. And I told my dad, what if now this also collapses? So like, then you have India to come back to, right? I'm like, okay. I don't know, miraculously or by grace of God, by the 3-year end, you know, once I completed my stint there and I had to come back for good, my brother, being a chartered accountant, advised me better not to keep portfolio out there because you'll be filing taxes in India. So I ended up encashing everything, and God was kind enough that same portfolio of stocks, after that Lehman Brothers collapse and the very bad start, yielded me an 18% compounded CAGR, which is very good for US market returns. Here 18% people are not happy, but for US 18% is very good. So that tells me, and guess what? You know, typical that Ahmedabadi mindset, what I tend to do is that same portfolio I put in Yahoo Finance. So I even till date try and see what value it is, because it's been almost like 12 years since I've left US. And today we are going to talk about 2030. So this initial summary, you know, resonates with what I'm trying to drive at. today the value of that portfolio at a CAGR of 16%, because I even had stocks like Nvidia back then at $17, which I had to sell it at $20, which were almost $400 now. What I realized is that, you know, I lost a lot of wealth creation by not being a long-term investor even in the US markets. So that is the same thought process that I'm driving at, that India is a country with great opportunity and we all should not miss this opportunity. So now the topic being Vision 2030 for our stock market investments. First thing what I've done is coming to the point, because there is a lot of data, a lot of things that I want to show you all. But first thing, you know, very simple. You know, what is a realistic expectation that we can expect from the Indian stock market? For some, it can be 10% compounded, which is very good. For some, it could be 15%. For some, it could be 20%. But let's talk very simplistic way. Currently, if you see, our GDP is sitting at around $3.17 trillion, right? I'm talking in dollar terms because now globally India is being accepted as a world strong superpower going ahead. Now, I've given a very simple number. I've given a number of growth of around 12% in nominal terms and around 7% in real terms. So the difference between real growth and nominal growth is real is without inflation. If you add 5% inflation to 7% growth, you get at nominal terms. Very simple. I have to project till 2030 because the topic is till 2030. So where we go at? We should be at a GDP level with such conservative estimates of $8.79 trillion. Any guesses what is the GDP size of China? Anyone? Please? 13, 15? 30. Sir, it is $19.5 trillion. And US is almost at $24 trillion. And Germany is also almost 4.2. So I have no doubt in my mind, and I'm sure none of you all have any doubt, that India will also reach to a stage where we are talking about GDP in terms of 8 trillion, 10 trillion, 12 trillion. It could take next 10 years, right? So now why this base is important, right, for this seminar? Because if you look in terms of market cap, now we always talk about this very famous Warren Buffett's market cap to GDP indicator, that your stock market capitalization in terms of US dollars is always linked with your GDP. So currently if our GDP is at 3.17 or 3.46 trillion dollars, your stock market is somewhere around, after this recent rally, at 3.15. So the ratio is around 80%, right? Now imagine where we will be at in terms of the stock markets. I'm just talking about index. I'm not talking about individual stocks, nor am I talking about any alpha generation. So we are just talking about, a simple index-based returns. I think very conservatively it seems the number comes to 9.24% compounded. There's a huge difference when I say compounded annual growth rate versus a normal growth, right? So we are talking about our stock markets hitting levels of $7 trillion in terms of market capitalization, bare minimum, and I put 80% to the 2030 GDP number, right? So it could even be 100%. If the sentiments are very good, it could be 100%. We could touch $9 trillion. Guess what? It took almost 35 years for India to touch, $2 trillion of stock market cap. Now from $2 trillion, which currently we are at 3.14, it is not going to take more than 8 to 10 years for us to add another $6 trillion. And when we are talking about quantum of $6 trillion, you can imagine the amount of wealth creation is going to lead to for investors like us. Now I think a lot of people who had come to know what is going to happen till 2030 will be feeling, khatam ho gaya, abhi nikal sakte hain, right? But now to give you that conviction, why something like this is achievable, because I find so much of skepticism. And the reason why I'm telling I find so much of skepticism is when I hear numbers of 20 lakh crore being pumped into bank fixed deposits during the COVID phase till date, 20 lakh crore, vis-a-vis only 6 lakh crores coming into the Indian stock markets. And currently we are sitting at almost 160 lakh crore worth of liquid investments in bank fixed deposits. I'm not saying it's a bad thing. vis-a-vis the entire mutual fund industry we are talking of is at 34 lakh crore, where most of it is in the debt and the equity element is quite less. So huge runway for a lot of new money to come in, and I'll show you in slides ahead. Now this is the average in terms of market cap to GDP, and if you can see, India has historically never gone a lot beyond 100%. So that is why the logical rationale to take 80% as the figure to compare what stock market cap will be at 2030 based on the GDP number that we talked of. Currently we are sitting at around 93%. One of Warren Buffett's very favorite indicator. In simplistic terms, it means when it goes above 100%, the markets tend to become little more expensive, and when it is say below 80% or say below 65%, it becomes a screaming buy. And historically it's proven, if you see all the crashes, they were at 55% levels, becomes a very good indicator to add more money to the stock markets. Now, why I want to give you a lot of background, because I think if you see what is happening right now, a lot of you all are reading a lot of newspapers, all of a sudden you are finding big companies talking about huge capex. And see, we are talking about an 8-year journey from here till 2030. What happens when the companies that I'm talking of or other part of stock markets build their capacities over the next 2 to 3 years? So somebody like Ultratech Cement is committing almost 12,800 crores to take its current 119 million tons per annum capacity to 153 million tons per annum over the next 4 years. That is huge capacity addition, right? And that's going to happen over the next 4 years. All of that capacity going up, driving earnings growth. And we know stock market returns are slave to the earnings. And I'll show you one slide to prove that as well. Tata Group is committing almost 60,000 crore, and this is committed only for FY23. I'm not even talking about a 5-year vision. We are talking about India's manufacturing exports touching almost $1 trillion. See, I'll be very honest, and luckily I'm not representing any political party, so I have no bias. I generally tend to undershoot the targets given by the government. So when government very optimistically talks about touching $1 trillion of exports by 2028, two things I will do. I will undershoot it by 20%, talking about almost $800 billion, which is currently at $400 billion. And I will increase 2 years. So I'll talk about not 2028, but 2030. But even that quantum of additional $400 billion of manufacturing related exports, which is just a shift from some other countries which are higher manufacturing base, or even a minute shift from China, can give us that advantage. So it is definitely possible. I have no doubt that it's not going to happen. Even if you look at automotive sectors, like after a long time I'm hearing companies like Maruti talking about 5,500 crore of capex. This capex is for new plants. What does it mean? The per capita demand for passenger vehicles in our country is going up. Any idea, any guesses, what is the current order backlog? I'm talking of passenger vehicle order backlog from only one company, which is Maruti Suzuki. It used to be 310,000 units. It's currently sitting at 340,000 units. And I'm sure a lot of you who are in the market to buy cars, especially the new cars, you're hearing about people telling you all that it will take 3 months, 6 months delivery times, right? What does this show? There's a huge demand, consumer sentiment is strong, and lot of the companies which in the past cycles have not been able to create capacities now in a rush to create capacity, which is very good for our stock market investments. Even a relatively smaller company like TVS, which is into two-wheelers, they are talking about a commitment of 1,000 crore worth of capex. And trust me, I know a lot of companies from South, Muru Grupas of the world, TVSs of the world, the Rane Groups of the world, they are one of the most conservative capital allocators. जब तक कस्टमर आके बोलेगा नहीं बाबा डाल कैपेसिटी, मैं तेरे को धंधा गारंटीड दूंगा, तब तक वो लोग कैपेसिटी नहीं डालेंगे. I met them. Versus if you see managements of North, Delhi, अरे आएगा यार डिमांड, डाल दो 1,000 करोड़ 2,000 करोड़, right? And then if the company goes bust, it is the bank which goes bust, right? So that is why we like the companies from the South, very efficient capital allocators. A company like Sundaram Fasteners, they just make fasteners. Now they are supplying to GMs of the world, NASAs of the world. They are talking about 750 crore worth of capex. My dad used to tell me that back then when Sundaram Fasteners used to commit a 5 crore yearly capex, we used to be like, wow, bada capex hai, bada earnings regrowth aayega, or EPS regrowth aayega, right? So this is some data on more capital expenditure. You know, Reliance is talking about 75,000 crore in new age, new energy businesses. Even the government companies are committing to huge capex. I agree, lot will agree to the fact that government capex is not very efficient in terms of creating shareholder returns, but yet that money coming into the economy, imagine ONGC doing a 44,000 crore capex, and imagine some part of that order going to L&T of the world. Y'all might be L&T investors, or y'all might be like invested in mutual funds which has L&T in your portfolio. So there is a multiplier effect, right? NTPC is committing, IOCL is committing, lot of these, Adani Group, everyone knows about, I need not talk more about it. The Tata Steels of the world. Imagine steel. It was in such a bad cycle for the last 8-9 years. And now, who could have ever thought, I remember this story because one of my very close friends was in the team of Mr. Muthuraman, and they were doing a presentation to Mr. Ratan Tata as to why they should not be buying Chorus. So Ratan Tata asked one thing, that currently we are 34th in the world in terms of steel capacity. What will it take us to reach 7th largest? After we acquire Chorus, we'll become 7th largest. So if I don't acquire Chorus, how many years it will take? So they gave a rough ballpark figure of 15 years. So Ratan Tata said, I don't care about the return on capital employed or the shareholder returns. I just want to be number 7th. And they acquired Chorus. And unfortunately, that was an acquisition at a peak of the cycle. A lot of shareholders' wealth was eroded for the last 10 years. But somebody who has been reading Tata Steel's annual report very diligently, because we, as a disclosure, we own very old Tata Steel shares, and when the annual report comes, every year I read. It used to be disappointing until the last 3 years. Because since the last 3 years, the body language has changed. The company has had a razor focus on the Indian markets. And probably 2-3 years down the line, after the Kalinganagar 5 million ton plant and the other inorganic acquisitions that they've done, once they are on stream, Chorus is going to become only 15% of the consolidated earnings. So now Chorus is no longer a risk. Market recognizes that and takes up Tata Steel from abysmal levels of 200 to 1,000 bucks. Right? So very important to read annual reports. If your journey till 2030 is going to be very good in investing, it's not going to be with advice of somebody else. Borrowed conviction se paisa nahi banta hai. Jaat mehnat zindabad. I tried to follow a lot of gurus and I failed miserably. Right? So borrowed conviction, you'll not make money, build your own conviction. Exports we talked about quite in detail, and I think we are touching $415 billion of exports. Yes, I think there'll be devil's advocate talking about the fact that that is because of the value terms. We were in an inflationary environment, so value बढ़ गया, volume का क्या? So volume is also improving. If you see the internal data, the volume is also improving. So just for people who maybe might not be very familiar with this concept, when Hindustan Unilever or Marico says last year मैंने 100 bottle parachute की बेची at say 10 rupees a bottle, so I've sold worth 1,000 rupees. Now, if this year also they sell 100 bottles, but instead of 10 rupees, they sell at 12 rupees. So the top line will be 1200 versus 1000. So 20% ka growth aaya, but that is because of value. But if Marico were to say that last year I sold 100 bottles and this year I'm selling 120 bottles, that is what the market loves to see in any sector, any product. You know, that is very important. Growth in volume terms. So if you see, a lot of things are happening on the ground, and because I am very deeply involved in this, I attend a lot of management con calls, I read a lot of annual reports, a lot of analyst reports, and one thing that I'm hearing constantly from a lot of companies is that we are in a capex mode. And by capex mode, it's not that they themselves want to do it. Their customers are driving the capex, and that is why probably the government came out with schemes like PLI to incentivize Indian manufacturing and Indian growth. So a lot of sectors like chemical, pharma, electronics, automotive, industrial, machinery, textiles, they are in a capex mode. There's this company called Lakshmi Machine Works, which is one of the highest, having the highest market share in terms of the textile machinery that they sell. They are booked for the next 2.5 years. 2.5 years they're completely booked. Now talking about the markets at a current level, and still if we are talking about 2030, I definitely don't want people to think that, I want to time the market, but yet I think there's always this eagerness to know what is currently happening with the market. And again, I feel privileged that because we are also mutual fund distributors, I tend to attend a lot of fund manager talks. And it is a privilege from those talks that a lot of knowledge that I'm going to impart today comes from their level of knowledge. So thanks to all those gurus. So current state of the markets are confused, and I'll tell you why. And it's not about the Indian markets. So Mr. Nilesh Shah at Kotak very nicely says that all of you all must have seen this movie Mughal-e-Azam, right? In that, what does Akbar say? Akbar tells Anarkali कि अनारकली सलीम की याद तुम्हें मरने नहीं देगी और मैं तुम्हें जिंदा नहीं रहने दूंगा. So currently if you see, there are a lot of such Akbars and a lot of such plays for our economy, which is Mr. Putin, very famous these days, thanks to his work that oil is booming, and Mr. Fed Powell, because every day we are worried about what will he do next. So we are talking about, we as analysts forecasting the markets. This is world's biggest central banker, the US Fed, Mr. Powell. See his commentary. So back in March 2022, he says Fed sees economic soft landing. Soft landing means there will be slowdown in the economy, but it will not be like a crash or not be a major recession. Then he says in May 2022, 12th May 2022, he says he can't guarantee a soft landing as the Fed looks to control inflation, right? This is the Fed banker changing his stance, and we are talking about predicting what's going to happen from 9:30 to 3:30. This is best. There's a great way to know what will the US Fed do. If you see height of Mr. Volcker, it's 6 feet 7 inches. He was the one who spiked up the US interest rates a lot as per his height. Then came Mr. Alan Greenspan. He also increased the rates as per his height of 5'11". Then we had Ben Bernanke, who also increased the rates as per his height of 5'8". Mrs. Yellen, she was unfortunately not very tall. She kept the interest rate zero for very long, which helped the stock markets globally. And now no more guesses, because Mr. Powell is 6 feet. What he's going to do with the interest rates is as simple as that. Nothing so much technical that we hear about in media. So some background on the global economy. Why global economy? You must be like, we are talking about India, India's growth story. Why should we care about global economy? India is a capital-starved country, and it's in our best interest that we get long-term capital. That is why these data are very important. So what happened during the COVID crisis is, no doubt the US Fed balance sheet was already expanded, but they had to expand even further for stimulus, right? So if you can see from 21 to 22, right from 2020 till 2022, lot of money printing happened in terms of trillions of dollars, and US Fed balance sheet increased a lot, which was one of the primary reasons to drive inflation world over. So now what happens? They have to put some brakes. So now they are in tightening mode. So by tightening, what I mean is they are increasing the interest rates to artificially slow down the rate of change of prices in the economy. And see what happens. When money, जो पहले बहुत सस्ता था because it was available at 0%, ever since the Fed has started increasing rates, all the bubbles are getting crashed. One of the bubbles being in crypto. I was getting so many queries on crypto that I told them, boss, I'm not qualified to advise you or talk about crypto. And I personally don't have a single penny invested in it. Some of my friends have made a lot of money that they're telling, but I have no idea. Some of the names I got to know while I was preparing this slide, Terra, Luna and all these, I had no clue all these things are in existence. And the best performance is negative 100%, totally wiped off. And the second best performance is negative 71%, right? So that is a performance sometimes in an asset class which we don't understand, but because it's a trend, and these days we try and follow a lot of trend which is more cool than the traditional stuff, this sometimes happens. Again, I think there's been brutal correction in the US stock markets. I have a lot of friends in US. Around 8 months ago when I used to talk to them, they're like, boss, my portfolio is booming, I'm enjoying. Just a couple of weeks back when I talked, they are like totally terrified with the amount of portfolio drawdowns that they've seen. Because a lot of my friends are in the IT sector, technology sector, software development. So their stock portfolio will be all the fangs of the world. Amazons and all these companies. So if you see the US consumer sentiment is weak, that is what is sometimes even helping our markets, because if the inflation is to come down, the US Fed stance might not be as severe as what it is perceived to be. So which is a good thing for us. Guess what? Somebody asked that why US had to print so much money and pay $1,200 to all the people who are paying taxes. The reason being 50% of Americans live paycheck to paycheck. And during COVID, when the jobs were totally lost, or some of the jobs were laid off temporarily, how would they purchase their groceries? So that is why the US Fed had to chip in. Luckily, India was not so pathetic, in such a pathetic condition. I think our management was quite better, I would say. We didn't have to print a lot of money, otherwise today we would have been talking about 15-18% worth of inflation. Good news for India. And this is something when I attend companies' conference calls, say companies like Polycab or companies like Hindustan Unilever. 2 quarters ago, they were extremely worried about unprecedented inflationary pressures which they have never witnessed since the last 10 years. Whether it is packaging cost, whether it is raw material cost, and there is a limit to which they can pass on the hikes to the customers. So what most of the companies did, they did packaging resizing. 100 ग्राम का पैकेट है, उसका 5 रुपए ही रखा, लेकिन उसको 70 ग्राम्स करके बेचा आपको थोड़ा पैकेट अच्छा दिखा के. Right? That is what they had to do. But again, there's a limit to how much they can do. So there's this company called Pratap Snacks, which I had visited the plant at Indore. They are experts at 5 rupee snack packets. They don't go beyond 5 rupees because then they have competition of Ruffles Lays. So I was asking him, sir, what happens when palm oil prices go through the roof, potato prices go through the roof? How do you manage this 5 rupee packet? तो कि मैं chips कम करता हूँ. That is the I tinker with the grammage. बोला सर अभी तो 5 ही chips बचे एक 5 रुपए के पैकेट में. फिर इसमें क्या कम करोगे? So okay, that is where my problem lies. Right? The inflation will have to come down. So if you see, the good news is a lot of these commodities which are very essential for India, and we are importers a lot of these commodities, they have come down, they have crashed well, 35%, 10%, whether it's aluminum, zinc, copper. Good news. So now I'm seeing a change in tone of a lot of these companies. They are saying that commodity pressures are seeming to come down, and going ahead with the price hikes we have taken, we might see margin expansion next year. So what happens when I always hear Asian Paints commentary, सब रोते रहते हैं. 43% मार्केट शेयर है डेकोरेटिव पेंट सेगमेंट में. रोते रहते हैं इन्फ्लेशन बहुत है, रॉ मटेरियल कॉस्ट प्रेशर बहुत है. 20% प्राइस हाइक ले लिया है. नाउ व्हेन द क्रूड कम्स डाउन, टिटेनियम डाइऑक्साइड कम्स डाउन एंड द क्रूड डेरिवेटिव्स कम डाउन, जो 100 रुपए वाला 120 किया है उसका 118 रुपए रखेंगे. सो व्हाट हैपेंस नेक्स्ट ईयर व्हेन यू सी द रिजल्ट्स, देयर इज अ ह्यूज मार्जिन एक्सपेंशन. This is what Indian companies and corporates are expert at, especially the ones which are into branded, which are having good market share. And these are the companies which are going to be part of your portfolios. So before interval, if we talk about, problem was higher inflation, interest rates, liquidity, demand was sluggish, growth was sluggish. Now after the interval, we are talking about reasonably controlled inflation. Still it's a problem, we need to watch, but again, it seems to be peaked, which is as per the commentary of a lot of managements. Interest rates, if not immediately, but on a longer run, will come down again. Liquidity would improve. Demand would be back and growth would be back. And we talked about the growth trends in terms of consumption in our country. So coming to Indian economy, FDI flows have doubled since 2013, and FDI flows are important because that is sticky capital. If Samsung is putting a factory at Uttar Pradesh, it's not going to be parked like how the FIs invest in the stock markets. Aaj dala, kal nikal liya. They're going to be here committed for very long. So this is sticky money, which is good, coming at a very decent pace. Exports I talked about, there was a lull period from 2011 to 2018 where the export growth was totally, there was no growth, it was flat. Right? We did depreciate as compared to the dollar, yet our exports were not picking. But now, thanks to a lot of incentives and thanks to China Plus One and a lot of things happening, I can go on in terms of discussing that. Because of time, I won't be able to, but we are at a good export growth rate. This is something very important to focus on. When will the companies talk about expanding capacities? When the factories are operating at high capacity utilization. So if you see from this data, the factories are operating at very optimum capacity, which goes to show that they have no other option but to expand. And if they don't expand, it will be a big problem. We talked about, why this expansion is important, but who supports this expansion? The banks. If you see the bank credit growth, which was almost at 4 or 5%, currently we are witnessing 11 to 13%. These banks will give credit to the industry will deploy it into factories, create more jobs, create more cash flows, again pay back their debt. That is how wealth is created in the stock market. It's a vicious cycle, but very interesting one. Our banks are totally cleaned up. There is no seeming to be any fear of new slippages in terms of asset quality. We are in pristine condition. The banks are adequately capitalized. In fact, they are finding the right contenders whom to lend. GST collections are pretty steady, which is again a good thing. So recently one friend of mine was talking about getting his interior done. So his big problem was huge inflationary pressure, not because the prices had gone up, but because he had to buy everything on bill. No vendor was willing to give without a GST billed, invoice. So all this revenue is going back to the government. Hopefully the government is again parking it back into capex in the country, which is driving the growth. So again, as I told you about the banks, the credit growth from a very abysmal levels, it's slowly gradually coming up at 11.5%. What is the rule of thumb? If GDP is growing at 7%, bank credit should grow at least 1.5 to 2 times. Very efficient banks like Kotak or HDFC or SBIs of the world, they will grow faster because they are so strong these days. They're taking a lot of market share from NBFCs and taking a lot of market share from the other weaker banks. Again, I talked about capex. This capex is divided into 3 parts. One is what the government does at the central level, one is what the states do, and one is what the listed corporate. I'm talking about the listed companies which are listed in the part of stock markets. You see there is tremendous growth in terms of FY23 estimates, which is again sign of boom, not for the short term, but for the long term. I talk to a lot of these chemical companies. So when they talk about putting up plants of 1,000 crores, 2,000 crores, I ask them generally how much time does it take to get highest asset turns or optimally optimize, the capacities. They say 2 to 3 years, and we are not going to stop there. At the second or the third year, you will probably hear us talking about further capex. So why I am putting so much emphasis on this? This is what should give us conviction that staying invested till 2030, I think we are in a dream run. Housing sector creates a lot of jobs for the unskilled, which is again going to help the economy, the rural sector. And again, housing, when we talk about housing, there's so many things involved. It's a huge multiplier to the economy, and that is one of the reasons why the government has kept this aspiration to have an affordable house to each and every Indian, right? And that is definitely seen on the ground when you hear commentaries from the cement companies, from Pidilites of the world. They are talking about this movement. I would not trust the government data, trust me. But when these corporates, who are private sector corporates, they talk about the volume growth, they talk about capexes, I think it justifies what efforts have been done. Credit ratio. What is credit ratio? Previously, when one company was upgraded, 5 were downgraded. You remember DHFL crisis, you remember IFL crisis. Now things have changed. If one company is downgraded, 5 are upgraded. And why this is important? I personally feel the credit rating agencies, with no disrespect to the government body, but they are sometimes like police. They come after the event has already taken place. But why they are very important? The banks are dependent on these credit rating agencies to decide which corporate to lend at what rate of interest. So when we see more upgrades, the banks are willing to lend to these corporates who would be stocks which you all are owning at a relative lesser rate of interest. Interest kam diya, EPS बढ़ गया, right? As simple as that. So this is a very good indicator, which I feel is a strong indicator, which gives conviction that long run it's looking very good. Monsoon, very important. Why so much of emphasis on monsoon? 50 to 55% of our population is dependent on agriculture. Entire part of it is in the rural. Rural is like a huge parallel economy for us, and that is growing at a lot faster pace because the base is low. And every budget you would be hearing, and even at AMF, fantastic budget sessions are taken place where you hear a huge allocation from the government given to the rural sector. I think this is fantastic. Any big global economies, whether you talk of China, it was a lot of urbanization that took place that drove the growth, which is what is again happening in our country. So monsoon is very important indicator. A company like Hero Motocorp, two-wheeler seller, sells 50% of its bikes in the rural sector. So of late, the company is not doing well because of the inflationary pressure. The demand from rural segment was quite tepid. But that is why it's very important to stimulate the rural sector, and I think a lot of focus is given there. Farm incomes have gone up. This is very important. And see, you have to understand that if farm incomes have currently gone up, the money multiplier effect of that in the rural economy will be witnessed over the next couple of years. So if you see this data, the farm incomes have been going up, which is a very, very important sign. The government, despite managing supply side inflation, has ensured that there are MSP hikes to a lot of farmers. And I think that is definitely going to be visible. And see, again, as I said, I don't want to trust what the government is saying. When I talk to PI Industries, when I talk to Make Money Organics, they are all these companies which supply to the farmers. And when farmers are increasing their volume intake of buying these fertilizers, these agrochemicals, genetically modified seeds, goes to show that things are working in this segment. So generally we call this as scuttlebutt investment. There are a lot of young people I see in the crowd. I think the best thing to do is to not trust the management blatantly. You have to go to the ground level, experience it yourself, and then decide how well the company's goods or products are accepted. So I talked about these smart package switching, by the FMCG companies, which will drive the margins and volume growth next year. Again, inflation seems to have peaked, but a big caveat is oil, and they call it as India's Rahu Kal. But again, I'll give you a data which will give you a lot of conviction that not only now, but in fact, even better going ahead, oil will become relatively an irrelevant commodity purchase for our country. So again, in oil, see the global exports. Citibank talks about oil prices at $65. JP Morgan talks about prediction of $380, right? So India is going to be one of the fastest growing economies for FY23, which is, there's no doubt, there's a lot of global statistics claiming that. Very important slide, very, very important slide, why you need to keep faith in India. Even in a challenging economic growth environment, which was the last 8 years, we had DeMon, we had GST implementation, we had the new government trying a lot of things, we had legacy issues, we had banks cleaning up their balance sheets, NCLT, so many things happening. It was not helping the sentiment to grow, right? Our economy is not firing on all 6 cylinders. It was probably firing at 3 and 4 cylinders. Yet you see what has happened. Economy size from the 10th largest in the world in 2014, we are 6th largest. Sharing global GDP from 2.6 to 3.2, still I feel this is very small. Generally, it's better to grow fast from a small base than to grow from a big base. So huge potential here. Sharing global trade and services from 2% only 2.2. Why? Because I showed you that slide where exports were flat and now we are witnessing growth. So now the emphasis is to get foreign capital, get forex, which is a good thing for our investments in the stock market. You see share in the global FDI flows from 2.1%, it is 6.7. I talked about this sticky money, very important. Auto production, we were the 7th largest in the world, now we are the 4th largest in the world. Steel, we were the 4th largest, now we are the 2nd largest in the world, right after China. This is a big thing. Mobile phone production, we were 12th largest, currently we are the 2nd largest in the world. Unicorns, we are again growing well there. This is very important. India's weight in the BRICS, that has gone up from 13% to 21%. Why this is important? Thanks to what has happened in Russia, we know for the fact that a lot of FIs have sold stock, and I'll tell you the reason also why they're sold. But when they come back, and they already started showing some signs of coming back, when they come back, they will have huge legroom to pump in a lot of money to take the markets to these levels of 7 trillion that they are talking of, because our weightage has gone up. So our weightage in the emerging market basket has gone up from 6% to 12%. China is at around 33%. In all other things, we are doing very good. Now, again, talking about 2030, so I have to show you the past 10-year returns of our indices, which were, I would say, not when economy was firing on all cylinders. We were witnessing a lot of reforms, and when we are witnessing reforms, immediately the action is not taken. It happens on the later date. So we are now expecting all these reforms taken are going to impact positively by 2030. Yet, if you see the indices, Nifty delivered 10-year return of 13% compounded. I'm talking of indices, I'm not talking of alpha generation, I'm not talking of active investment. This is passive investment. Nifty mid cap did 15%, small cap, the riskier one in 10 years did 15%. Guess what? Even in the next 8 to 10 years, if we get anything like 11% in Nifty, 12% in mid cap and 14% in small cap, do you think a bank FD will be able to beat this? Answer is no. So to beat inflation, this is the only avenue. I have a lot of data in terms of lot of sectors also, energy, realty, and the good thing is that there has been leadership in new sectors, which are the old economy sectors, which were lackluster since the last 8 years, and now all of a sudden we are seeing capacities being built up. Lot of things our economy has faced, whether it is the US taper tantrum, the NBFC crisis, but see the resilience of our economy. We have bounced back strong, and we have not had any major hiccups as compared to a lot of other economies, especially our neighbors that are facing, right? Sri Lankas of the world. India is always little more expensive in the emerging market basket, but I'll tell you why. If you see the data, this is what the Goras, the FIs have earned from the Indian markets over the last 10 years. And again, a rationale for them to sell in India. Trust me, they have lost money in the last 3 years from China, where they had 33 out of 100 rupees, 33 rupees were parked in China, and they have lost money there. Now they are answerable to the clients back in US, back in Europe. So what will they do? To balance out the portfolio, they have to sell the profitable country, which is what? India. In India, they have earned 996% return since 2003. So it is obvious they have to sell India. And that was, I think, painful, and that is the reason why the markets have corrected. But thanks to we guys, thanks to the DIS, a lot of money has been pumped in, right? But now imagine when these Goras, they are not going to sell off completely and just take their stock to zero. Out of the entire $3.14 trillion market cap, $640 billion is owned by the FIs. They have sold only going from 23% weightage to 17-18% weightage. So they have sold around $60 billion. They're not going to make it to zero. But now imagine when they come back to reinvest in India, they'll be able to invest with a bigger basket because our weight has gone up. This is what I don't want any of we Indians to miss until 2030 in terms of humongous wealth creation, which is not going to happen with our own money being invested, but the foreign capital which is going to flow to our country. Not even China, Brazil, South Africa, no other country has done as well as India. And that is why we always get a premium in valuations. And again, important data, FIs have mainly sold in IT and banking sectors. Rather, they have been net buyers in some other sectors. So it's not that they're completely quitting on the country. It's probably sometimes the media that writes that FI have, because of FI, the markets have crashed, so on and so forth. They are bullish long term in India, but sometimes out of majburi they have to sell. And I've explained you the majburi, China. Now, what if they were to relentlessly keep on selling further? By grace of God, and thanks to we the investors who have participated in the market, see the liquidity ammunition we have to ensure that even further, we all know about the 12,200 crore SIP flows. वो कम नहीं होने वाला, बढ़ ही रहा है, वो तो help कर ही रहा है. Beyond that, what do we have? Imagine if the FIs were to further sell more due to any other rhyme or reason, another black swan event, whatever. We have the actively managed equity funds who are sitting on 70,000 crore of cash to be deployed in equity over a period of time. Balance advantage funds have 50,000 crore, NPS has 15,000. The total amount we are talking of 3,25,000 crores. So there is protection, which was not the case previously. When we, the domestic investors, were hardly participating, it was not the case. So now things are relatively different for us to ensure that you can withstand such shocks coming from the FIs. Again, if you see the corporate profitability going up, we talked about that. Very important. When I talk about a 12%, 13% returns from the stock market annualized, it is not going to happen when your company's earnings growth are not going to be to that quantum. This is a pool of 1,000 companies where if you see right from the old days of 2001 till date, जितना पैसा कंपनी का ईपीएस ग्रो हुआ है, प्रॉफिट ग्रो हुआ है, उतना रिटर्न्स इन्वेस्टर्स को लॉन्ग टर्म में मिला है. एज सिंपल एज दैट. एंड आई हैव नो डाउट दैट कॉर्पोरेट इंडिया विल ग्रो नो लेस देन 11 to 14% compounded their profits till 2030. So that is a ballpark figure you can assume in terms of returns that you will earn. Current valuations, lot attractive than they were 6 months ago. Definitely lot attractive. So if you're thinking of long term, now is again a good time. Don't try to time the market, as Peter Lynch very rightly says. Far more money has been lost trying to time the market or trying to time corrections than the real corrections itself. If you see in terms of PE ratio, very famous amongst we retail investors, they are at quite a reasonable levels. Again, I talked about crude. Why crude is now not such big a problem. Back in 2008, what was India's economy size in terms of GDP? 33% of combined GDP of Brazil and Russia. In 2011-13, we are at 39%. Currently, see our size of purchasing power in terms of our economy. We are at the size of 100% of Brazil and Russia combined. So this is a huge change which helps us to mitigate these crude shocks. Obviously, crude up to certain level is bearable, but beyond certain threshold, it is detrimental even to US. So then, we being a relatively smaller GDP, it does have an impact. But crude doesn't stay forever up. So that becomes a good opportunity for investors to take advantage of those volatile times. I talked about FII ownership. Again, historically, a very simple data. Every year I have interns from AU, Nirma. One thing I tell them is, just give me some data. Data in terms of what has happened when investors have parked money whenever the markets have corrected by a meager 15%. I'm not talking about 20, 30, 40%. Guess what? The next 3 years have been high double-digit, high-teen returns, which is very satisfactory. So if you see every time when there's major drawdown in the economy and you've stayed invested or you're pumped in more money, your returns have recovered well. We do a lot of number crunching with mutual fund also, because these days I think it's a very mature product for a lot of retail investors. And what we realize, a 1 year SIP or a 2 year SIP, the probability of making losses is almost high, 30%, 40%, 50%. But guess what? By the time you reach the 5th year, you maintain that discipline, the probability of making losses becomes zero. I'm not talking about very high returns or anything, but what people fear in equity markets, what if in long term I make losses? So here is a tool which helps you to mitigate that. Very recently this came up. There was this Bloomberg survey of a lot of global credible analysts talking about what is the probability of recession in various countries. And they've come to India talking about the probability of recession is almost zero. Technical definition of recession is 2 consecutive quarters of degrowth in GDP. US is already in recession as per the definition, but very conveniently being the superpower of the world, they are saying that, every time this definition doesn't work. બધું સગવડ્યું છે US માં. Okay, so now there's this last video I want to show, and one of the biggest mistakes which has led me to a lot of initial losses in the markets was by overly tracking media. But I think this video shows us how efficiently we can track media and what we should focus on rather than focusing on what the media says.
Inflation का काफी प्रेशर है जनता पर. We have somebody here with us. Let us talk to him.
He's worried about inflation. He's taking
a
a poll.
National news.
National news, sir. Economy को लेकर what do you think, sir?
Prime time, sir.
Yes, sir. What is your?
Pavitra, if you are watching,
1 second.
I'm sorry.
Take it again. Sorry. Volume through વધારી દો.
Inflation का काफी प्रेशर है जनता पर. We have somebody here with us. Let us talk to him, sir. आपको क्या कहना है, sir, economy को लेकर?
National news.
I'm starting from again.
Inflation का काफी प्रेशर है जनता पर. We have somebody here with us. Let us talk to him, sir. आपको क्या कहना है, sir, economy को लेकर?
National news.
National news, sir. Economy को लेकर what do you think, sir?
Prime time, sir.
Yes, sir. What is your?
Pavitra, if you are watching, I'm sorry.
No. I was wanting to talk to you about economy, sir. Inflation is so.
Just because I forgot your birthday, that doesn't mean I don't like you. Like, I like you. Which boyfriend remembers birthday?
Every boyfriend remembers birthday, sir. So what gentleman is saying is because of the economy, inflation, pressure being so.
I didn't poison your dog for nothing.
Eh?
It was disturbing your sleep. So that's why I poisoned it. It didn't die, no? It's still in ICU. It's alive.
So what the gentleman is saying is the economy is in ICU, but it is still alive. There is chances of sir. Ho gaya, sir.
Just because I slept with your best friend, that doesn't mean I don't love you. I still love you. I still love you. Right?
I don't want to comment on that, sir. But government is our best friend, is what this gentleman, sir. नहीं पूछना है sir आपसे कुछ.
Your aunt kissed me first.
Eh?
And you only told be polite with my relatives, right? Like if she kisses me, as a polite person, what will I do? I kiss her back. What's wrong?
Plenty. हाँ मनोज, इकोनॉमी क्या माचोदाने सर, आपका रिश्ता क्या पवित्र के सर?
So Pavitra Rishta, sir.
So please, sometimes with no hard feelings, but treat media like that. And there's a last slide. I'll not take more time, but I love this slide, and very diligently I follow. What is the relationship, the Pavitra Rishta between economy and the stock markets? So the stock market is like an excitable dog on a very long leash in New York City, darting randomly in every direction. So there is this owner of a dog who takes his dog for a walk at a particular place, and daily the path is same. But see the difference. The dog's owner has done the same walk for years, starting at Columbus Circle through Central Park, ending at Metropolitan Museum. At any one moment, there is no predicting which way the pouch will lurch. डॉग कहाँ जाएगा, दूसरे फ्रेंड्स को मिलने जाएगा, कुछ सूंघने जाएगा, हर जगह पे जाएगा, हर जगह घूमेगा, राइट? बट द ओनर इज वॉकिंग टू हिज पाथ एट एनी मोमेंट. So again I talk. So but in the long run, you know he is headed northeast at the owner's direction. कहीं पे भी जाएगा, एंड में तो ओनर के पास आ जाएगा, राइट? So at an average speed of 3 miles per hour, the owner's speed. What is astonishing is that almost all of the market players, stock market players, big and small, seem to have their eye on the dog, which is the market, and not on the owner, which is the business. So if you have conviction and focus on the business, let them miss earnings for 1 quarter. Let them talk negative for 1 or 2 quarters. But long term, when you see, you're going to reach the destination. So this is where I'll conclude. Thank you very much for your patient listening, and I'm open for any question answers. Thank you.
Anybody has any question? So I'll come there.
I think so. Mic chahiye kya? Very informative, as usual. Every year you come and explain. Can you tell us what will be the probable Nifty at the end of 2030?
That's a tricky question, but I gave you the market cap. So I told you Nifty should be sitting at a market cap of no less than $7 to $8 trillion by 2030. So when we are talking about adding almost $5 to $6 trillion in terms of Nifty's market cap, more than that, sir, with a very simple 12% nominal compounding, which was the first thing I showed. So at least 3 times, conservatively at least 3 times from here over the next 8 years, that is what we should expect. I'll be disappointed if you don't touch that, based on the prospects and so much of bhashan that I've done today.
Okay, there is a question. You just stand up. Stand up. Can you go there, please? Sorry,
Sure. No?
take 4 or 5 questions.
No problem, sir. No, I hope I've done on time. Great.
Hello. Panic sell happened in Feb 2020. Nifty was down by 38%. Currently, the data shows 3.66 lakh crores is sold by FII, and currently DII bought 2.82 lakh crores in last 9 months. How you see this?
I'm very happy that they are selling, and I'm very happy to see that they are selling and they are getting a lot of liquidity buying from the DIIs. Why I'm telling you this? Imagine a scenario where we had not supported the market and the FIs had to forcefully sell, and they had to sell because of, I told you about the China reasons. What trust they will have in the Indian markets? Talk about your own portfolio. Say you have Reliance and you have some very micro mini cap, maybe say something like Anjani Portland Cement, where daily the volume is of 1,000 shares. Now, the weightage of yours in Anjani Portland is very high, and you have to sell that company in one day, and you're not able to sell. What will be your experience as an investor? It will be bad. But the same Reliance, if you have to sell, you will be in like 5 seconds, your 1,000 Reliance will be sold. Same thing has happened with FIs. They've realized that Indian markets have matured despite we selling. Because of time, I couldn't show you some other data. This selling that FIs have done, and you very rightly and very smartly pointed out some very good figures. This selling has never happened to this quantum before. And imagine all of that getting absorbed without the markets crashing more than 20%. The maximum drawdown of Nifty from the peak was only 20%. No doubt the stocks would have corrected more, because as I told you, FIs sold more of the sectors like banking and IT where the weightage was more. But then they were getting IT stocks at 30 times, mid-cap IT at 45 times. Why will somebody not sell? All of that was absorbed very healthily. And the best part is, we are still not done. We are still under-owned. We Indians are under-owned in terms of our ownership in the Indian equity, which will go up slowly and steadily. But the FIs cannot just zero down. From 23% weighted, they have come to 18%. So now, because of things that I talked about in Russia and other countries, and now India's weightage going up, imagine the intensity. What happens when they come buying in the Indian markets and we as SIP doers are still buying the Indian markets? Good thing, and I feel it's a good thing, and thanks to them we got this opportunity to buy markets cheaper. When you go to do shopping, will you buy more bags of your shopping goods when you have 50% off, or you will buy them when there is at MRP?
With the V-shaped recovery, Nifty IT has given the return of more than 3 times. How you see the IT sector?
Okay, so talking about IT sector, luckily the IT sector 2 years ago had a lot of tailwinds in terms of, because of COVID, they didn't have a lot of travel cost. They were able to do a lot of cost cutting because all the leases that they do in Bangalore and US and onshore and offshores, there are a lot of cost cutting because of that, because a lot of people are working from home. So that was a margin tailwind that all these companies had. And what happens when there is an event like COVID? 2 types of client budgets are there. One is cost optimization IT spend, and second is efficiency or growth related budget. So what we witnessed post-COVID was growth-related IT spend, and now the commentary that you hear of a lot of these IT companies, they are talking about efficiency-enhancing IT spends. Because of inflation, companies want to be more efficient. So IT will grow, but any sector, howsoever good it may be, people talk about IT being one sector where a lot of free cash flow is generated. You don't need to involve a lot of capital. A lot of capital is given to shareholders, but all things at a proper valuation is must. And the good way to do is compare a 5-year valuation chart, see where you are paying top dollars right now despite the growth. That will give you a good judgment what are good entry points.
Thank you.
Thank you.
One last question. Yeah, there is some.
Sir, so because of high inflation, FDs is not a good investment option right now. So should one invest their entire capital into stock market, or they should do some government guaranteed bonds or something like that?
Fantastic question. Thanks you brought this out, because I am so much passionate about equity. One will feel that, you know, sar ke bache baal bhi equity mein dal do. Never do that. Most important guru mantra, what I have learned the hard way, I'll be honest with you. I have had times where entire 100 rupees of my capital were in equity and I had crying days. Don't do that. Asset allocation is most important. Ideally, what happens is, you know, what is a good asset allocation depending on age, risk factors. Say 30-35% of your net worth could be in equity because you are relatively lot young, maybe more, not less. 30-35% could be in real estate depending on your age, your affordability, and 30-35 should be into fixed income and liquid products. Why that is important? Because if you are always fully deployed in equity, how will you take advantage of the recent fall? How will you take advantage of the COVID-led fall? I talked to some investors who are big ticket investors in the country. They are individual investors based out of South, based out of Pune. They are managing portfolios of 2,000 crore of their own money, not company's money, not PMS. So one thing I've learned from them is always be 10 to 15% in pure liquid position. That money can give you golden opportunities either in real estate, either in the gold market, or either in the stock market. But then you can encash and earn more returns if you are not always fully deployed. So it's very important to decide an asset allocation with your financial advisor based on your risk appetite and, more importantly, your age. I hope that answers.
Thank you.
Thank you, sir.
Okay, so just a couple of formality, Parthiv, for you. So please be here. Okay. So big thank you to Parthiv. I think a round of applause. Parthiv, it was very convincing input to all of us. It will be beneficial to all of us and online also. And as a part of AMA, would like to give you a sweet memory of your presence today. First, I think give my personal memory. I am author of one book, Principle of a Responsible Investment.
It's an honor. Thank you so much. It's an honor.
Yeah, one personal photo for my memory. I don't mind.
It's an honor.
Yeah, doctor, can you help me? It was very convincing. One more, Parthiv. This is one more sweet memory. So before you leave the room, if you have further